What if I told you that every financial crash, from the first tulip bubble to the crypto collapse, follows the same script? What if market euphoria was just history forgetting itself again? What if you could learn to time the market simply by understanding what always comes next? Imagine being able to predict the next big crash or boom. In this video, we'll uncover the hidden history of money, from the madness of Tulip Mania to the rise of Bitcoin. We'll explore the patterns that repeat and the lessons we can learn. Stay tuned, because by the end you might just see the financial world in a whole new light. Welcome to episode 9 of the Hidden History of Money series, where we cover the topic of Tulip Mania to Bitcoin, what financial bubbles teach us about timing the market. Please remember to like, share and subscribe to our Finance Arcana YouTube channel if you like our content. Today we go deep from the Dutch tulip craze to the rise and fall of Bitcoin and uncover the 5 unchanging phases of every bubble. Stay with us to the end and I'll share the bonus timing strategy used by the smart money, the one tool that could save you millions or help you make your next fortune. From the South Sea bubble to the housing market collapse, we'll explore the patterns that repeat through history. Understanding these cycles can be your key to financial success. So buckle up and get ready for a deep dive into the hidden history of money. 1636 Amsterdam, the world's first recorded financial bubble. A single tulip bulb, once just a flower, becomes a status symbol. Prices skyrocket, not because of value, but because someone else might pay more tomorrow. This phenomenon, known as Tulip Mania, saw prices for some bulbs reach the equivalent of 10 times the annual income of a skilled craftsman. The allure of easy money drew in everyone from noblemen to chimney sweeps, but like all bubbles, it burst. By 1637, tulip prices plummeted, leaving many in financial ruin. This was a lesson in the dangers of speculative investing, a lesson that echoes through history, from the South Sea bubble to the dot-com crash, and even to the rise of Bitcoin today. Sound familiar? It starts the same way every time. A new asset, a new narrative, a new promise. This time it's different, and for a while it is. In the 17th century, tulips were the new sensation. People believed they were the key to unimaginable wealth. The same way, in the 21st century, cryptocurrencies like Bitcoin emerged, promising a revolution in finance. Both tulips and crypto started with a simple idea, a new asset that could change lives. Tulips were just flowers, yet they became symbols of status and wealth. Bitcoin, a digital currency, promised to decentralize money. The frenzy around tulips led to skyrocketing prices, much like the meteoric rise of Bitcoin. People invested heavily, driven by the fear of missing out. The narrative was compelling. This time it's different. But history has a way of repeating itself. The tulip market eventually crashed, leaving many in financial ruin. Similarly, Bitcoin has seen dramatic drops, reminding us that no asset is immune to market forces. So, what can we learn from tulips and crypto? Both teach us about the power of narratives and the risks of speculative bubbles. While the assets may differ, the underlying human behavior remains strikingly similar. Section Descent into Madness. The Euphoria phase. The late 1990s. The internet is the new frontier. Everyone's a genius. Companies with no profit, sometimes no product, are worth billions. Valuation? Irrelevant. Momentum is the only religion. The stock market is a roller coaster, and everyone wants a ride. Lavish parties, extravagant lifestyles, and the belief that the boom will never end. It's a time of boundless optimism and reckless speculation. The euphoria phase is a heady mix of excitement and delusion where reality takes a backseat to dreams of endless prosperity. Fast forward to 2017, then 2021. Crypto, NFTs, meme stocks, FOMO becomes fuel everyone buys, not because they understand, but because they can't afford to miss out. The crowd is all in. And that's the trap. Bitcoin's meteoric rise in 2017 was just the beginning. By 2021, Ethereum and other cryptocurrencies followed suit, reaching unprecedented heights. NFTs, or non-fungible tokens, became the new digital gold rush, with digital art selling for millions. Meme stocks like GameStop and Dogecoin captured the public's imagination, driven by social media frenzy. The fear of missing out, or FOMO, pushed people to invest blindly, hoping to catch the next big wave. But as history shows, when everyone is all in, the bubble is bound to burst. Section the crash, the moment of reckoning, the bubble always bursts. Tulip prices fell 99% in months. .com stocks lost $5 trillion in market cap. Bitcoin plunged from nearly $70,000 to under $20,000. These moments of reckoning are inevitable in speculative markets. The frenzy of buying drives prices to unsustainable heights, and when reality sets in, the crash is swift and brutal. Investors are left grappling with massive losses, and the economy can be thrown into turmoil. History has shown us time and again that no matter the asset, be it tulips, tech stocks, or cryptocurrencies, the cycle of boom and bust is a constant. Understanding this pattern is crucial for anyone looking to navigate the treacherous waters of financial speculation. The pain is real. Fortunes vanish, reputations are destroyed, families are torn apart, dreams are shattered, and yet, this is when the real learning begins. In these moments of despair, we find resilience. We discover the strength to rebuild. We learn the true value of perseverance. The journey through financial ruin is harrowing, but it is also enlightening. It teaches us humility, patience, and the importance of making informed decisions. The scars left by these experiences are deep, but they also serve as powerful reminders of our capacity to overcome. In the end, it is through these trials that we grow, adapt, and ultimately thrive. Every bubble has the same shape, the same phases: innovation, early enthusiasm, mania, crash, despair, then healing. From the Tulip Mania in the 17th century to the South Sea bubble in the 18th century and the .com bubble in the late 20th century, the patterns are strikingly similar. Each of these financial bubbles started with a groundbreaking innovation that captured the public's imagination. This was followed by early enthusiasm, where savvy investors saw potential and jumped in. As more people joined, mania set in, driving prices to unsustainable heights. Eventually, reality caught up, leading to a crash and widespread despair. But over time, markets healed and lessons were learned, only for the cycle to repeat with new innovations. In recent times, we've seen similar patterns with Bitcoin and other cryptocurrencies. Understanding these patterns can help investors navigate the turbulent waters of financial markets. This isn't about charts, it's about human psychology, greed, herd mentality, and the belief that we are smarter than the last generation. Financial markets are driven by emotions. Fear and greed are the puppet strings that control our decisions. During Tulip Mania, people believed tulips were worth more than gold. It was irrational exuberance. Fast forward to the dot-com bubble, where the internet was the new gold rush. Again, emotions ran high. Today, Bitcoin and cryptocurrencies evoke similar feelings. The fear of missing out drives prices up. Behavioral economics shows us that we often follow the crowd, believing we are making rational choices. But in reality, we are influenced by the same emotions that have driven market bubbles for centuries. Understanding these psychological factors can help us navigate the financial markets more wisely. Markets don't crash because of valuations. They crash when beliefs break. The question is not if, but when. Financial textbooks often focus on numbers, charts, and theories. They provide a structured view of the market, emphasizing fundamentals and valuations. However, the reality is that markets are driven by human emotions. Fear, greed, and panic can cause sudden and dramatic shifts. When crowd emotions take over, rational analysis often goes out the window. This is why understanding market psychology is crucial. Comparing financial textbooks to crowd emotions is like comparing a map to the actual terrain. One is theoretical, the other is real and unpredictable. The key to navigating financial markets is to balance both perspectives. Use the knowledge from textbooks, but always be aware of the emotional undercurrents. After every crash, the ashes become fertilizer. The internet didn't die in 2000, it matured. Bitcoin didn't vanish after 2018, it evolved. Timing the market isn't about prediction, it's about preparation. Understanding timing means recognizing the cycles of growth and decline. It's about seeing the opportunities that arise from the rubble. Just as the Tulip Mania gave way to more stable financial systems, modern crashes paved the way for innovation and resilience. The key is to be ready to adapt and to learn from the past. Timing isn't about predicting the future, it's about being prepared for it. In every downturn, there's a lesson. In every recovery, there's a chance to grow stronger. So the next time the market crashes, remember, it's not the end, it's a new beginning. The best investors, they study the cycle of emotions. They don't buy when it feels good. They buy when others are paralyzed. They don't chase highs. They wait for blood in the streets. The investor sentiment cycle is a powerful tool. It starts with optimism, where investors are hopeful and confident. This leads to euphoria, the peak of excitement and risk-taking. But then anxiety sets in as markets become volatile. Panic follows, where fear dominates and many sell off their assets. Capitulation is the point of maximum despair, where investors give up. But after the storm, hope emerges and the market begins to recover. Finally, recovery takes hold and the cycle starts anew. Understanding this cycle helps investors make informed decisions, avoiding the pitfalls of emotional trading and capitalizing on opportunities when others are fearful. Here's the bonus, the strategy that Buffett, Druckenmiller, and Templeton swear by: be fearful when others are greedy, and greedy when others are fearful. This principle has guided some of the most successful investors through turbulent markets and economic downturns. Warren Buffett often emphasizes the importance of this strategy, especially during market bubbles and crashes. Stanley Druckenmiller has also highlighted how this approach has helped him navigate through financial crises. John Templeton, known for his contrarian investing style, believed that the best opportunities arise when the market is in panic. By following this strategy, these investors have managed to achieve remarkable returns and build lasting wealth. Remember, the key is to stay calm and make rational decisions when the market is volatile. This bonus timing strategy can be a powerful tool in your investment arsenal. Track the VIX, the fear index. When it spikes above 35 to 40, historically the best long-term buying opportunities appear. When euphoria reigns and the VIX falls below 15, tread carefully. The VIX, or volatility index, measures market risk and investor sentiment. High VIX levels indicate fear and uncertainty, often leading to market corrections. Conversely, low VIX levels suggest complacency, which can precede market downturns. By monitoring the VIX, investors can gauge market conditions and make informed decisions. Remember, a balanced approach is key. Use the VIX as one of many tools in your investment strategy to navigate the complexities of the financial markets. It's not magic, it's not a crystal ball, it's pattern recognition, and it's your edge. The VIX, often referred to as the fear gauge, spikes during periods of market uncertainty. Historically, these spikes have coincided with significant bottoms in the S&P 500. By studying these patterns, investors can gain insights into potential market reversals. For instance, during the 2008 financial crisis, the VIX reached unprecedented levels. Shortly after, the S&P 500 hit its lowest point, marking the beginning of a recovery. This pattern has repeated in various market downturns, providing a valuable tool for traders. Understanding the relationship between VIX peaks and S&P 500 bottoms can offer a strategic advantage. It's about recognizing the signs and making informed decisions based on historical data. So while it may seem like magic, it's really about leveraging knowledge and patterns. This is your edge in navigating the complexities of the financial markets. From tulip petals to digital tokens, the script never changes. History repeats, or at least it rhymes, but now you know the rhythm. Understanding the past helps us navigate the future. The lessons of Tulip Mania and the rise of Bitcoin are more relevant than ever. Stay curious, stay informed, and keep exploring the fascinating world of finance. If you enjoyed this journey through the history of money, don't forget to like, share, and subscribe for more insightful content. Join us next time as we delve into another captivating chapter of financial history. Until then, keep questioning and keep learning. The next bubble is forming right now. Will you be the victim or the strategist? Subscribe to Finance Arcana, where we don't chase hype. We decode the hidden history of money to help you profit from its future. Imagine a world where financial wisdom is accessible to everyone. At Finance Arcana, we believe in empowering you with knowledge so you can make informed decisions and seize opportunities. From the lessons of Tulip Mania to the rise of Bitcoin, history has shown us the patterns. By understanding these, you can navigate the financial landscape with confidence and foresight. Join our community of forward thinkers and visionaries. Together we can build a brighter, more prosperous future. Subscribe now and start your journey towards financial enlightenment. Remember, the sun always rises after the darkest night. With the right knowledge and strategy, you can turn challenges into opportunities and dreams into reality. Thank you for watching Tulip Mania to Bitcoin. What financial bubbles teach us about timing the market. Stay tuned to our other upcoming episodes of the Hidden History of Money series.